Do you have a net worth of $14 million or more? Well, did you know that if you plan to leave a legacy, $1 can be taxed 3 separate times if you don't do the proper planning? And yes, you heard me right. In tax planning, there are 3 separate tax systems that are relevant to the legacy that you leave behind. So we have the income tax system, we have the estate and gift tax system, and then we have the generation skipping transfer tax system. Each tax system plays a role into how much your heirs will get into their pockets after all the taxes are paid out to the government. Don't worry, I'm breaking it down so you don't have to. First, we have the income tax system. Most people are pretty familiar with this system already. This is where your earned income is taxed based on where your income falls within the federal tax brackets. For those of you that don't know, pre-taxed accounts, like traditional IRAs, are taxed at your federal income tax bracket level. So if you leave pre-tax IRA dollars to your heirs after 2020, your heirs, with some exclusions of course, have to draw down those retirement IRA dollars within a 10-year window. And what they're going to be taxed at is going to be their income tax brackets where they fall. This is one of the worst ways to leave a legacy because it's a gift with strings attached, and of course those strings being taxes. Next, we have the estate and gift tax system. Not many Americans are worried about this in recent years because of the huge exclusion we have with estate and gift tax currently. In 2023, an individual can leave $12.92 million, or if you're married, $25.84 million to your heirs estate tax-free. Anything you leave in your estate above that threshold will have a estate tax levied on those dollars anywhere from 18 to 40%. I know what a lot of you are thinking right now. Shannon, how will I ever reach that amount? Well, we know the current tax law is sunsetting starting January 1, 2026. So our huge lifetime exclusion that we have right now is said to revert back to $5 to $7 million per person, or $10 to $14 million per married couple. And we know 20 years ago, back in 2003, the estate and gift tax exclusion amount was only $1 million. So if you left behind more than $1 million in 2003, anything above that threshold was taxed up to 49%. Tax laws are constantly changing, but people don't consider the fact that their current assets have the time to grow and compound over time, which could make them a candidate of hitting one of those thresholds. So at our firm, we like to plan with the end in mind to make sure our clients are set up for success. And finally, we have the generation skipping transfer tax system. This is an excise tax that's imposed in addition to the gift and estate tax on transfer of property to generations that are 2 or more generations younger than the donor. So for example, if a grandparent leaves an inheritance to a grandchild but skips the parent's generation was skipped to avoid paying estate tax twice versus the parent getting the estate and then the child getting the estate. The government always wants their fair share of tax revenue. So this tax is imposed to stop individuals from skipping generations and not paying estate taxes at both levels. Wealth building is so much more than just investing in the stock market. And if your advisor is not currently talking to you about these topics, it might be time for a new one. For more wealth building tips like these, follow or subscribe and like for more.